Check. What?
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Tuesday edition of The Real Investment Show. We've got a lot of stuff to get into this morning, but first of all, there is a deep, profound sadness across America this morning as all the prognostications of the end of the world did not happen yesterday with the eclipse. It was not the second coming of Christ, but I tell you what, I did see just tons of great videography of the eclipse. So yesterday at my house, it was so rainy and cloudy that I couldn't see anything, so it didn't matter. But saw some really great videography. But the best one, the best video of the eclipse came from a Starlink satellite, which showed it from the view from space. And if you're a flat earther, you may not believe this, but it shows the curvature of the earth, and it shows the black shadow crossing the earth with the eclipse. Really fascinating. So if you get a chance to see that videography from the Starlink space satellite, it was really great in terms of its impact on kind of the eclipse. So anyway, so that was it. Nothing really happened yesterday. Everybody was expecting outages and all kinds of stuff. Didn't happen. And the market did okay yesterday. Market traded back and forth a bit. Again, we'll get into this in a second when we talk about what you need to know before the bell. But everything's really kind of just holding firm where we are right now. Now, today we have the NFIB economic report. So that's the National Federation of Independent Business. And so they're going to report out what small businesses are seeing and feeling about the economy right now, which is vastly different, mind you, than what CEO confidence looks like. CEO confidence has been improving markedly, not surprisingly, and we'll talk about this in a minute, but as share prices rise, CEOs are feeling a lot better about things. So, their wealth is going up. I feel good about the economy. So, but small businesses, very, very different story. So we're going to get the NFIB confidence survey out this morning, and we'll see whether or not it shows any improvement. Over the last several months, there's been a big dichotomy between what's reported in terms of economic data from the government saying that things are doing great. We're having this fantastic recovery in the economy. Small businesses, not so much. Now, why is small businesses important? Because they're 50% of employment in the economy. They are a very big employer. They have a very important place in the overall economy. They're not so happy and thrilled about what's going on. So we'll see what that says. And also there's some good kind of indicators about recession in markets that are tied to that NFIB data. So we'll have some more of that to talk about after today. Tomorrow, of course, is the inflation data. So we'll get CPI out tomorrow. That'll be for the month of March. And we'll see if there's, kind of what's happening. Now, interestingly enough, there was a survey out this morning. I actually shouldn't say a survey, an article out this morning talking about interest rates in different states. And this is important because we talk about inflation and everybody says, well, inflation's this, well, bah humbug, it's cost me a bunch to, buy food and groceries. We talked about yesterday, millennials' big splurge for this year is going to be groceries. But it's very interesting when you see inflation broken down by state. this is why people are so adamant about there being problems with the inflation data. In the Northeast, inflation on a year-over-year basis as of last month was about 1.5% to 1.75%. Much lower rate than what the inflation data says. Come to Texas, it's 3.75, 3.6 in California. So again, when you get down to different states, every state has different inflation rates. And this is why people see inflation so very differently from different perspectives, because it depends on your age, where you live, how you consume, what kind of food and groceries do you buy, what type of activities do you do. Everybody's inflation rate is different, and they are felt different. It also depends on how much money you make versus the prices you're paying for things. So people in lower income brackets experience inflation much differently than those in higher income brackets. So again, these all have a big impact, but this is why there's such a big dichotomy between what people see and hear about inflation versus what's reported as inflation. And this is why we have such a divergence with that. But again, we're going to get that number out tomorrow. Of course, there'll be plenty of breakdown and analysis on inflation when we get it, what's driving it, what's causing it, etc. But markets are kind of just hanging out here waiting for that inflation data, because that's going to be the driver for the Fed. We just had a very strong employment report, probably suggests that the Fed's not going to cut rates anytime soon, but a very big drop in inflation maybe tomorrow, well, that could put a Fed rate cut back on the table. So that's just what markets are waiting for and looking for. So here's what you need to know before the bell this morning. As we talked about yesterday, we actually have something to talk about for a change with the markets, because as of last Thursday, we did break below that trend line, that 20-day moving average. That was important. We said then, hey, be careful. Don't knee-jerk react to that, because these things can give you kind of a whipsaw. And of course, on Friday, we recovered the 20-day moving average, held above it yesterday. So as of this moment, that break of the 20-day moving average has now been negated. The markets are just fine. We're hanging in there. And there's been no change to the bullish trend of the markets. So again, this is why it's very important to never react to that first initial break. And this is what happens with a lot of people when they're trading technically. They set a stop level and say, okay, here's my stop level at this price. They crack it, they immediately sell the whole position, and then the stock goes right back up in price, and then they're upset and they go, well, see, technical analysis doesn't work. I tried to follow it, and I sold too early, and the stock kept going up. That's why you want to be careful about these initial breaks. You got to give them a little bit of time to confirm that there's been a change in the direction of the market. Right now, that has not occurred as of yet. Now, the one thing to do pay attention to, of course, is that we do have a previous kind of topping process that was set into place, and the market has now been declining in terms of the price momentum. So we're seeing weakness, we're seeing some cracks in that very strong kind of bullish trend that we had previously. So as the market was trending higher, it was a very steady kind of pace of momentum in the market. That's starting to kind of show a bit of a peak. Think about as you're running up a hill, as you start running up the hill further and further and further, and that angle of ascent, you start to kind of slow down as you get further and up that hill. And that's what's happening here, is that momentum, very strong coming off the bottom in November, but is now kind of starting to taper off here, and we're seeing some signs of weakness. So again, it doesn't mean that we're out of the woods. This initial break of the 20-day moving average, it is a warning sign, and it's worth paying attention to that momentum is weakening in the overall markets. But what we're looking for now is for a close this week below the 20-day moving average. If we close below that, we'll now start to confirm this weakness. If we don't, then we'll see what happens next week. But again, we're starting to, there are some initial cracks. It's worth paying attention to, but not worth acting on just yet. And this is why we have to give things a little bit of time to kind of work themselves out in the market. So, as you're trading your own portfolio and as you're managing your money, it's important to have stop levels, and it's important to have, levels where you're going to sell. But as those levels are triggered, two things happen. When you tend to trigger a sell signal, generally you're getting pretty oversold, so you're going to get that bounce. So when you get that break, that's a good opportunity to say, okay, now there's a change to the kind of the market tone, which is happening. use this bit of a bounce in the market to go ahead and sell into if you need to reduce some risk. And then if you begin to confirm this break, then you can take more aggressive hedging in your portfolio. So that's what you need to know before the bell this morning. When we come back, we're going to talk a little bit about margin debt this morning. That has a lot of implications of what's happening in the market. Also, John Penn joining me this morning to talk about markets, money, and more. Don't go away. We'll be right back after the break. You're listening to The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season Candid Coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome to the show this morning. So on the website this morning, we had a new article out talking a little bit about margin debt. And the reason that I wanted to revisit this morning is because margin debt is a really good indication of kind of market exuberance and things that are going on within the markets and kind of where people are positioning themselves. But there's also a lot of misunderstanding about margin debt and what it means and how it impacts the markets and those type of things. So, I wanted to go through a couple of things because, there's some interesting aspects to margin debt and its relationship to the markets itself. And so, for instance, we talked about valuations here recently. And valuations are a terrible measure to manage your portfolio with short term. Valuations are terrific about telling you what long-term returns are going to be over the next decade, but from 1 month or 1 year to the next, they're just terrible timing devices. But what valuations do tell you, bring the chart up, Brent. What valuations do tell you is that there is a very high correlation to consumer confidence. So if we take valuations and overlay that to our consumer confidence composite index, there's a very high correlation, and it's not surprising as people feel more confident about the economy. They're more confident about overpaying for assets, right? Because the economy's doing great. This company's going to make more money, so I'm willing to pay more in terms of valuations and price for that. Now, importantly, that same type of premise applies to margin debt. So as individuals start feeling more confident about the markets and they're feeling more confident about where the markets are headed, then they're willing to take on and leverage those bets within the market. So if we take a look at the annual rate of change in consumer confidence versus the rate of change in margin debt, very high correlation, not surprising. As markets are going up, we get more confident, we want to take on more leverage, take on more risk. And then, of course, there's a feedback loop to this, which is CEO confidence. As asset prices rise, right, corporate stock rises, CEOs feel better about what's going on with their company because they're making more money. So they buy back more shares, which helps improve their earnings base. And so not surprisingly, very high correlation between CEO confidence and share buybacks. So you've got share buybacks going up. They're the major buyer of stocks in the market since 2009. That lifts asset prices. So people take on more leverage through margin debt to chase markets higher. And you get this virtual spiral within the markets. So again, all of this just a function of psychology, whether it's valuations or whether it's margin debt or anything else. It's all a function of psychology. And so again, we take a look at our recent fear greed index, which as at one of the higher levels recorded. Now, very different than the CNN index. Our index is based on how people are actually allocating money. Where, what do they actually have in equity allocations? And that's reaching very, very high levels historically towards, this is just kind of very representative of an extremely exuberant market. They're very, willing to take on risk. And so we're seeing that. And so margin debt, unsurprisingly, rising. And, we're seeing a very, very big tick up right now in margin debt. Now, we haven't seen the advance in margin debt that we saw back in 2021, right? That anomaly occurred because we had $5 trillion worth of stimulus thrown into the markets. People had a lot of excess cash. And then, of course, that all got wiped out in 2022. They had to cover margin lines. They burned up a lot of that cash, so they don't have the same availability to do that type of surge in margin debt we saw previously. But we are seeing margin debt levels rise fairly sharply right now because of this kind of exuberance in the market. And of course, there's a way that we look at margin debt in particular, which is called net free cash balances, right? So you have margin debt, but that margin debt is based on two factors, which is the collateral you have in the account and the amount of cash. So that tells you how much you can borrow. So as prices are rising, my availability of taking on more debt and using my cash to leverage with increases because I'm getting rising asset prices. And so as investors take on more and more debt, it declines what we call the free cash balance of those accounts. In other words, how much free cash do they have left to do that? So if I invert that free cash balance on the chart, you can see there's a very high correlation between that and the stock market. And we are currently at near record levels. Not yet, but we are near record levels of negative free cash balances currently. So in other words, investors are about as heavily margined as they can be right now in the overall market. And that's just representative of the overall psychology. And this is why if we take a look at, we talked about this recently, but the deviation of the market from the 24-month moving average, so that's a 2-year moving average, mind you, is extremely high. And not surprising. As markets have been rising, we're getting deviated further and further from long-term means, but that's all representative of that exuberance in the market. Now that I've laid all that out for you, let me tell you the thing about margin debt to understand. That isn't a warning sign as it is, right? You just don't sit there and say, oh, well, that means I need to get out of the markets. No. Margin debt is just a representation of psychology in the markets. That's all it is. And we talked about dynamite a few weeks ago in terms of the markets, et cetera, and said, look, there's all these ingredients. If I give you the shell and the glycerin and everything you need to make dynamite with it, if I just give you a pile of ingredients, what are you going to do with it? Nothing, right? They don't mean the ingredients themselves don't mean anything, but once you bind them properly, you get dynamite. Now, dynamite itself is not a problem as long as it's stored properly, right? And you don't have to worry about it. And this is the same thing with margin debt. As asset prices are rising, people take on more debt. That's okay. Nothing wrong with that. It's like dynamite, right? Nothing wrong with it as long as markets are rising. When dynamite becomes a problem is when the appropriate catalyst is applied to the dynamite. Then you've got the problem. That's margin debt. Because what happens with margin debt is right now it's completely inert. It's fine. Market prices are rising. As market prices rise, people take on more leverage because they have more collateral, etc. But the problem becomes when the market begins to decline, because as markets decline, the value of your collateral declines. And at some point, you have to cover that leverage. And here's the problem. Margin debt is not at your choice. It is at the choice of the broker-dealer that provided it for you. So you get a phone call from the brokerage firm, and they say, Mr. Johnson, actually, Mr. Penn, you have to cover your margin debt today. You need to either put in this much cash or sell this much in assets. So you go, well, I'll just sell some of my assets. I'll sell some of my losers that I've been performing. So you sell those. And then you get the call from the broker-dealer, Mr. Penn, you need to sell some more stuff. But I just sold more stuff. Yes, but you now have less collateral in your account. So now you need to sell some more stuff to meet the new collateral requirements in your account. So you have to sell more stuff. Mr. Penn, you need to sell some more stuff because now you have less collateral in your account. And that's what happens. As prices are falling, people are having to liquidate to meet those margin calls. And if they don't, and here's the thing about margin calls. Margin calls are not at your, as I said, are not at your discretion. If you don't meet that margin call, the brokerage firm will meet it for you. And they tend to liquidate a whole lot more than they need to in order to shore up that margin line. Because, again, the credit line is at their discretion. They loaned it to you based on the collateral in your account. So the risk of margin, this is the thing you need to understand about margin debt. On the way up, it is supportive of a bull market because people are taking on leverage. They can buy more stuff. That drives asset prices higher. It works in reverse when markets begin to decline, and it fuels just as margin debt fuels the rise in markets, it fuels the sell-off in markets as well. Now, right now, we don't have a problem, right? But it's just something worth understanding that we are getting very, very aggressive in the overall markets, and we're getting very leveraged up in terms of the market. And that's just adding the potential fuel to the fire, so to speak, of a correction when we get one. So that's why, whether we get a correction now or later this summer, whenever it is, but that's why instead of maybe it being a 2 or 3 or 5% decline, it's probably going to be a 10% decline. Because we'll have some of that margin get unwound during that correctional process during the summer. So anyway, again, the article's on the website. I go through all the charts and the graphs for you, but it's all there. So simply go by the website, realinvestmentadvice.com. And, just be aware. Again, it's not, it's not meant to just make a claim. It's like, oh my gosh, you need to sell everything out of the markets now. That's not the point. It's just something you need to be aware of. It's a dynamic of the overall market. John, any comments?
Well, I think it's just amazing at how quickly investor psychology can change.
Yeah.
Right? I mean, at one moment, it's a very fear of loss mentality. I don't want to lose. I don't want to lose.
October.
Right? And
just
now it's all
October.
of a sudden, it's like, well, wait a minute. Well, why don't I have more equity exposure?
Yeah.
Wait. Now it's more of a fear of missing out. It's like, well, what changed?
Well,
right? What changed with your plan? Why the need to feel like you need to take on more risk at this point? Right.
It's very interesting because last summer we were talking. In June and July we had this very same rally in the market, up 17% for the year going into July. It was all about AI, artificial intelligence, and we were talking about, hey, we're going to have a 5 to 10% correction. And we said, when you get one, it's going to feel worse than it actually is because it's been such a low volatility advance. Mm-hmm. Of course, in the summer, we had a 10% correction, almost on the nose. It was 10.03%. It was quite fascinating. And by October, investor sentiment was extremely negative. Nobody wanted to be in the markets. Everybody was convinced that we were going back into a bear market. And now, 5 months later, we're right back to where we were in July.
It's like, how quickly do we forget, y'all?
Right? Exactly. And what that means is we're going to have a 5 to 10% correction this summer, sometime between now and the election. And it's going to feel terrible. But it's only because of the greed level we've got now, right? So just be aware. All right, when we come back, earnings season to test the market rally. Earnings start on Friday. So John and I will talk about that when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season Candid Coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
If you take a look at a lot of these videos that are getting put out on TikTok, it's like, working for the rest of my life, I'm just supposed to do this forever because I need money. The struggle is real for the new generation, which is now learning that 9 to 5 isn't as easy as going to college.
The Real Investment Show podcast. Same show, your schedule.
My daughter, she's 17, and she's discovered Kroger points for getting a discount on gas.
At realinvestmentadvice.com.
The struggle is real.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So on the break, John and I were talking a little bit about margin debt, and John brought up a really great point. You know, as I said, you know, right now when you kind of look at margin debt, it is rising fairly sharply, but it's kind of dwarfed by that big spike in margin debt that we took on in 2021 as we had all this excess cash coming in. Of course, that was going to a lot of younger people that were jumping onto Robinhood, taking on margin debt to, you know, trade stocks and trade options, etc. But John brought up a really great point about the difference now versus then, and I thought that was I thought the level of interest rates was interesting.
Yeah, I mean, brokerage firms, they love it when you take out margin, especially right now. Especially if you look at just the interest expense, you know, just to take out that margin loan, right? So, right now, just on average, and I was reviewing margin interest rates. On average right now, a margin loan or to borrow using margin will cost you anywhere from 11.8, call it 12%, up to a little over 13.5%. That's not a small amount of money.
Right, and which you've got to overcome.
And you've got to overcome that.
Right.
So you got to hope that if you're borrowing that you need to make up that on your own investment strategy to make sure that you're in the positive here. Because whether you're up or down, guess what? The brokerage firm that you're taking that margin loan from, they're going to charge you no matter what. The most competitive margin rate that I found, at least right now, was 9.25%. But in order to get the 9.25%, your margin loan, the amount that you need to be borrowing needs to be $1 million or more.
Right.
That's huge.
Now, I just want to throw something out there. John did this research in a matter of just a few minutes, so don't start emailing me. Well, at Interactive Brokers, you can get it for 8.5 or whatever. I am sure there's probably some firms out there that offer lower, margin rates that will get you out there. But again, on most of your major broker firms, they're going to be prime plus 2 or 3.
They will. So it's amazing. During the break, there was a commercial there from Interactive Brokers. There right there, Lance. And there it looks like their margin. And this is not a prop for them. I'm not promoting Interactive Brokers, but it looks like they're in the 6 or 7% range. So you can find some things. I'm sure there are some things you need to do to qualify for that. But the rest of the industry out there you're in the double digits.
Yeah. Well, and here's the important takeaway from this is that during 2021, the Fed interest rates were at 0. And your margin rates were 3% and 4%.
Oh, huge!
So the point is that the one of the other reasons behind the besides just the lack of capital available that we don't have anymore because a lot of those stimulus checks are now gone, is interest rates are a big difference as well. So the increase in margin debt, don't ignore it. It's larger than it looks. But it's, again, things have all gotten kind of skewed because of that big jump that we had in 2021. And that's why I look at free cash balances, which are very close to a record, because that strips away levels of margin debt and everything else. It's like how much free cash you have. And that's not much because everything is pretty fully margined at this point for what is available. So anyway, good point, John.
Thanks.
Yeah. You brought one today. It's better than Danny does.
Wow. Right there. Zinger.
Hey, you know what?
Hey,
I take grief from both of them on Fridays. So, you know what? All fair's in love and war, right?
It's get a little hot in here.
Friday, he's not even listening. It's too early for him. So on Friday, we begin kind of earnings season. We're getting some earnings. We'll have some earnings on Thursday and Friday. But starting Friday, we're going to get some of the major banks coming out. JP Morgan, Wells Fargo, et cetera, will come out on Friday. And then really we'll kick off earnings season in earnest next week. And again, we'll get most of the regional banks. Again, that's going to be kind of the interesting thing to watch is these regional banks. Are they in trouble? The bank term funding program that was put into place last March because of the to bail out Silicon Valley Bank, et cetera, and these regionals, that all expired in March of this year. So this is going to be the first earnings report following the expiration of the bank term funding program. So look, that won't be represented as such in the earnings, right? Because the earnings were for the first quarter. The bank term funding program was there. What will be interesting to hear is the CEOs of these banks, these regional banks in particular, and what they say about the health of their bank. Of course, they're going to spin it to be good, but is there stress there as this bank term funding program has expired? And so that'll be the interesting thing. So really next week, we'll get a really good look at kind of what's happening with regional banks. But importantly, if you take a look at earnings, the first quarter earnings have been guided down. Not surprisingly, we talk about this all the time. In fact, I just wrote a report on this 2 Saturdays ago in the newsletter at the website talking about earnings seasons coming up. We've, as usual, we've guided down on first quarter earnings pretty heavily. Every sector of the S&P has had lowered earnings guidance with really the exception of technology. So the focus is really, in other words, X technology, the decline in earnings would be much deeper. And in fact, if you take a look at earnings X technology in the S&P 500 going back for the last several quarters, earnings have been declining across the board for every sector except technology. So again, this has been the one big driver. The one thing kind of supporting earnings has been the massive share buybacks in the technology stocks and their ability to grow earnings. And X that, earnings are declining for the rest of the S&P. So again, just something to kind of pay attention to.
Well, and you got to take a look at too. I think there are going to be a lot of eyes and ears on a lot of the upcoming earnings announcements. to find out really about what's the forward guidance, or what is the outlook from these various companies, whether it's banks or industrials or staples, whatever that may be. And ultimately, I think it's going to come down to what's the health of the consumer, right?
Right.
Because, I mean, how do these companies derive or get their earnings? I mean, how much of the economy is driven by the consumer?
70%-ish.
Right.
Roughly. It's like 68.6
right.
last time I checked. So,
I think, when you look at what the market's done so far this year, do you think a lot of the returns so far this year are kind of on the premise that the Fed is going to cut rates? Do you think that's really been driving the market? And what if that doesn't come to fruition? What if the Fed doesn't reduce rates?
We know this is a very interesting thing about the markets, right? Mm-hmm. And this is all about, and it's always interesting about Wall Street and a lot of the narratives, because you'll remember that last summer, right? The market was declining, and the reason the market was declining because the Fed wasn't going to cut rates as soon as everybody expected, mm-hmm. and which made sense. And that was, all during 2022, the market would rally or decline based on whether or not the Fed was going to cut rates or not. And every time the market would rally expecting the Fed to cut rates, the Fed's come out and say, no, we're not going to cut rates, and the market would sell off. This has been interesting since November. In November, the market was expecting 7 rate cuts this year. And the Fed has come out and said, no, we're not going to cut rates 7 times. And the market has now repriced expectations from 7 to 3, and yet the market keeps going up on this. Now the market's down to 2 rate cuts this year, and the market's still rising. So, in other words, this has been a market this year. It's been very interesting from the fact that, the narrative has completely changed from underneath. Why are you buying stocks? I'm buying stocks because the Fed's going to cut rates 7 times this year. So based on those rate cuts, I can overpay for earnings and valuations. And so people are overpaying for stocks. We're driving up price of the market faster than earnings expectations, right? So you have valuation expansion. And yet, as the whole narrative about Fed rate cuts is falling apart, people are still chasing. Well, they're still going to cut it twice. What happens if we get to 1? What happens if we get to none, mm-hmm. right? The Fed's not going to cut anytime. So now what's your narrative? And this is always the interesting thing, right? We were cutting rates, when rates were at 0, we were willing to overpay for stocks because rates were 0. Now rates are 5.5, and we're willing to overpay for stocks because now the Fed's going to cut rates. Pick a narrative, right? Yeah. And then that's the great thing about the market is no matter what's really going on, the market can spin that narrative so that they can put a bullish spin on it, right? Just keep buying stocks because it really doesn't matter what the narrative is. Just keep buying stocks is the real theme.
Yeah, but at some point you would think let's say if the Fed doesn't cut rates this year or cuts them much less than expected, we're going to have to come back to earnings at some point. Profitability, revenue, growth, mm-hmm. cash flow, it needs to matter at some point, right?
Well, you would think. Right. And valuations will ultimately matter at some point, but when? True. And what you have to have, and again, what you have to have is a catalyst, something that comes along that all of a sudden the market has to reprice earnings expectations. Right now, earnings expectations are that we're going to have a record level of earnings growth over the next 3 years. And we're going to be growing earnings above the long-term earnings growth trend of peak-to-peak growth going back to 1947. We're going to grow earnings faster than we've ever grown them before over the next 2 years. And so what that requires is an extremely strong economic recovery because earnings, it's where earnings come from. They mm-hmm. come from earnings. They come from economic growth. So we've got to have very strong revenue growth, very strong economic growth over the next 2 years with low inflation, low interest rates. If you don't get that, it's going to be very difficult to generate those earnings. And at some point, something happens that the market has to reprice the way it's thinking. Yeah. And that's where you get the ultimate decline. But, again, that could be 5 years from now. Right.
Yeah, so it's just amazing how the exuberance out there all kind of ties into what you were talking about earlier with looking at the increased margin debt and, mm-hmm. How there's that psychology out there right now where it's like, well, I'm really kind of skittish. I don't know how much I really want to invest. And all of a sudden it's like, well, wait, I really want to get more equity exposure here, right? It's just amazing how quickly the pendulum can shift from one extreme to the next, right? Yeah, it really is. Very quickly.
Yeah, look, and we see it with our clients
mm-hmm.
too. I mean, we have clients that come to us like, oh, I'm extremely conservative. I just don't want to lose any money. And then, and now it's like, how do we get more equity exposure?
Right. It's like, wait a minute.
I don't want to own bonds now. I just want to own equities. And I'll tell you, some of our clients are the best contraindicators out there.
There are a couple. Oh,
There are
yeah.
a couple. All right, quick break. We'll come back. Get ready to wrap up the show. Don't go away. 1.46 million. I'll tell you why that's an important number today. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season Candid Coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
There is a consistent kind of run of financial advice in the media that it just bothers me to the core because it's so bad. But you'll see these articles all the time. The new magic number for retirement is 1.46 million. Sounds great, right? So all you need is 1.46 million and you can retire comfortably. But what they don't tell you is all of the math behind that, which is flawed, deeply flawed on many things. Like, for instance, at 1.46 million, that's great. That'll give you a certain lifestyle. But that also banks on you getting 7% every year on your money. Up years, down years, doesn't matter what the market does. You've got to make 7% every single year so you can take out 4% and adjust for inflation at 3%. Problem is markets don't work that way. We've talked about that numerous times. Here's the other big problem with this. We talked about this recently. Fidelity just came out with their survey of all their retirement accounts, and they said, we have a near record number of 401k millionaires. Well, near record, when was the last record? Oh, that was in 2021, right before the bear market in 2022, and we're not back. Those 401k millionaires are not back yet, even though the markets are rising. They haven't gotten back to their $1 million status yet. But how many of those 401k accounts are $1 million plus? That's 2%, right, of the total population. So where's the rest of it, right? And this is always a problem. These magic numbers are great. It's like, hey, you just need 1.46 million. You know, the problem is the average American has like 100. The median balances are like 130,000. right? Average balances are a little bit higher, but not by much. And the issue is they're nowhere near the 1.46 million or 1 million or 10 million or whatever you need. But John will tell you this from years of financial planning. It depends on your lifestyle. 1.46 million isn't 1.46 million back in 1980. In 1980, if you had $1 million to retire, I could go buy treasuries at 13%. I didn't have to worry, right? Cost of living was about $55,000. Today, cost of living is $75,000, right? That's just your house, your mortgage payments, all that stuff. And it takes about $75,000 for a family, right? And that's not frills. There's no frills in that, right? That's just the cost of living.
That's just living.
That's just living. And so 1.46 million, is difficult to do that. And if your lifestyle is, 100,000 or 150 or 250 or whatever your lifestyle is, that's what is going to determine what your retirement number is. And so, these articles are great. I guess it gives people a sense like, oh, I've got 800,000 in the bank. I can almost retire. You really can't use these rules of thumb of your money's going to double every 7 years or every 9 years, and you're going to take out 4%. It's all going to be great. It doesn't work that way in reality, and that's the big issue.
Yeah, I think there's a disconnect out there a little bit when it comes to trying to forecast or try to predict what your returns are going to be in the future. Excuse me. And nobody knows what this market's going to do, right? But I think it's easy when you put a financial plan together. If I were to say, Lance, if you could just count on your money compounding it, 12% a year every year moving forward, guess what?
All right, Mr. Ramsey.
Yeah. See, there it is. So it's interesting. So I was visiting with a client last week.
Right.
And we're about to start their financial plan, right? And so because he is like, here's where my wife and I are. Here's what we're saving. This is what we think we spend. But I'd like to retire or work less in about another 15 or 20 years. He said, right? So, but I'd like to know what amount do I need to save to get there, and what sort of return assumptions are we going to use? And I said, well, and I also want to know, what do you think you may spend, not just on your basic living expenses. What about college expenses for the kids, maybe weddings for daughters, travel, all these things. It's not just the basic living expenses, it's everything else. And he made the comment, he goes, well, let's just, not to talk a little bit about Ramsey, what I'm going to, I think Dave's done a great job of helping people get out of debt when it comes to his envelope strategy. He's helped a lot of people there. But when he's out there talking about, well, just find a growth mutual fund that averages 12% a year to look at your future returns, I'm like, man, it just doesn't work that way. Right? Even the client I was speaking to, he said, man, Dave's on crack. Those were his exact words. I said, you know what? I'm going to steal that, and I'm going to use that on the show next week.
Well, we just had a 3-year example of this, right?
Yeah.
I mean, the market's lost over 20%, roughly 20%, in 2022. So where's if you're banking on 12, you've got to make up that 20% loss plus the 12% you didn't get, and so you're consistently behind the curve, and that's why these compound returns in markets never work. And this is why it's so very important when you're doing your financial planning. And honestly, I've been threatening for years, and I may just have to break down and do this, but I've got to find a programmer for this. But I'm going to build a financial planning software that uses real rates of return over time, where you get up years, down years, and variabilities, and you can plug in different scenarios for interest rate shocks, et cetera. Because that's what really happens to money. And, the vast majority of financial plans I see from other firms when they come in is like, oh, yeah, if you just get 6% a year, you've got a 98% chance of surviving retirement. That's great. It just doesn't work that way.
Yeah, there was the lady I spoke with, it's been about 2 months ago now, pretty recent. And the firm that she was visiting with at the time, they put a plan together for her. And they told her, well, we're going to use a conservative forward-looking rate of return for your plan. And that number was 9%.
Yep.
It's like, wow. I mean, hey, that's great. If the market gives you that, wonderful. But maybe are we going to plan on that? Maybe we should just plan on a more conservative forward-looking rate of return. And to your point, if your plan can survive and you've got that probability of success that, hey, you're not going to outlive your assets. You're not going to be a burden to your family. You're not going to be a burden to your children. And if we can use a forward-looking rate of return that's more conservative and your plan is still successful, hey, great. In those years where you do get 8, 9, 10, 11, hey, 12%, you know what? Go spend money. Go do it. Gift to your kids, gift to your family, give to charity. But you know what? Let's not bank on that every year. Let's use a just, look at where valuations are in the markets right now. Let's just try to put some forward-looking assumptions that make sense, right?
And look, it's there's some interesting chat going on right now on our YouTube channel. So feel free if you're watching the show and you're not driving, join the YouTube chat. There's always some interesting comments and things that are going on there. But one is talking about stuff that people have done that have been in other areas, right? So Beanie Babies and Mahomes trading cards, et cetera. Here's kind of an interesting side note to that. There was an interesting graph out this morning. This is the percent change in luxury goods since over the last decade, so over the last 10 years, so 2014 till now. And this is the decade-long price performance of luxury goods compared to the S&P 500. So this is the price change relative to the S&P 500. Rare whiskey. See, my problem with collecting rare whiskey is I would drink it.
If I consume it, does it still have
no,
value?
No, it has no value if you consume it. It becomes rare, yes. Can you sell the byproduct?
Now there's a market idea.
This is distilled whiskey.
This tastes funny. That's fine. There's nothing wrong with it.
There's nothing wrong with it. 280% for rare whiskey. The S&P 500 is only up 158% over the last decade. Wine is up. So good wine is up 146% versus 158 for the S&P. Watches up 138%, although there's a crash apparently going on in Rolexes right now. So maybe this is time to go out and buy a Rolex. Art's up 105%. Cars, rare cars, sports cars, those type of things, not Brent's Miata, is up 82%.
Hey, that's a nice looking ride out there, Brent, I got to say.
It is, but it's a Miata. Not a big rush for Miatas. 67 Corvettes, yeah, all day long, right? Handbags, if your wife's been telling you that, she needs to buy expensive handbags because it's an investment, she's right.
I hope Shauna's not listening
up
this morning.
67%. Coins up 56%. Furniture's up 40%. Jewelry's up 37%. And colored diamonds are up 8%. So the worst investment over the last decade relative to the S&P has been colored diamonds. So there you go. But anyway, so rare whiskey, though, that's apparently the place to be. Collect your rare whiskey. I'm not sure exactly what I'm not a connoisseur of whiskey, so I'm not sure exactly what classifies as that. Is that
I don't know. I mean, you could probably put a really rare
I'm
whiskey
sure
in
it's
front of
not
me.
Jack Daniels, right?
No, and then you could probably to me they would probably taste the same. Honestly, I wouldn't know.
Yeah.
Right?
I'm sure some people in our chat will have some ideas about rare whiskeys. So
I think so too.
Yeah, I am sure. But the interesting thing is that, and this also goes back to other categories as well, right? So, gold's having a great run right now. Everybody's like, oh, gold's finally you're making some money in gold, right? But it's vastly underperformed the S&P over the last decade. It's always about investing. And as we've talked about before, it's important to invest in things that are generating return over time rather than just making bets that are, out there. So you kind of really understand where you're investing and what your returns are going to be and what your most likely returns are going to be, and kind of make your bets accordingly. But anyway, well, Johnny, closing, I'll give you the last 30 seconds.
No, I think it all comes down to, and I've heard you say this time and time again, Lance, is know what you own, right?
Okay.
I mean, know what you own, know what you're putting your money in, and it's not a bet. It's all about balance.
Yep.
So just parting words of wisdom: know what you own, and if you don't know what you own, hey, reach out to us. We're happy to help you.
Yep. By the way, I talked about the NFIB earlier this morning. That report was out due this morning. It did just come out. And optimism for small businesses has slid to an 11-year low. The main culprit, Bidenomics. So small businesses not optimistic at all about what's going on. Again, 50% of the economy, that's worth paying attention to. All right. Be right back tomorrow with Danny Ratliff for Wednesday, of course. And we'll see what the market does today. Futures pointing up a little bit this morning. We'll see if we can hang on to that 20-day moving average. We'll update you tomorrow. Have a great day. Get by the website. Get our latest article out on margin debt. It explains everything. If you don't understand margin debt, it explains it all. It's all at the website, realinvestmentadvice.com. Send your questions, comments, and emails. Most importantly, just have a great day. See you back here tomorrow.